Hello everyone, today I will show what is yield to maturity, YTM or simply yield of a bond and how to calculate it. YTM of a bond is total return on the bond if it is held until it matures. It assumes all coupon payments are reinvested at the YTM. First let's understand what a bond is. Bonds are fixed income securities and are considered safe measures of investing. Bonds are debt securities issued by government bodies and corporates. They are issued to raise debt. A bond has these main components. Settlement date is when the buyer has the ownership of the bond. Maturity date is the date at which the buyer receives the face value from the seller. Par value or face value is the redemption amount which the issuer pays the buyer of bond on the maturity of the bond. Price of the bond is the price at which bond is trading. It can be issue price or market price. Coupons are fixed payments by the issuer. They can be paid annually, semi-annually or quarterly. Calculated on the par value. Maturity is the difference of settlement and maturity date. Yield I have already explained. The investor purchases a bond from the issuer for the issue price or at the market price, receives the coupons periodically which are interest payments, and at the maturity gets the par value of the bond or sells the bond to other party, which is the capital gains. Although bonds are considered safe investments, but the caveat is, it is safe only when you hold it till the maturity, else there are fluctuations in price which can offset the returns of coupons. Let's see what this bond is. The settlement date or the date of purchasing is 6th November. The maturity is 5 years after issuance. The par price is 100 which will be paid on maturity. Price of the bond is 103. Coupon rate is 8% paid annually. And the maturity as we saw is 5 years from now. YTM is the rate at which the present value of all the cash flows from bonds equal to the price, basically in other words the rate of return we can expect from the bond if we invest in the bond till its maturity. In bonds, there are two cash inflows for the investors, coupons and par value. First, let's calculate the present value of the coupons. Let's assume that the YTM is 6%. Coupon is calculated on the face value of the bond. The coupon will be 8% of 100, that is 8 rupees. The coupons will be paid for the next 5 years, so 8 rupees for the next 5 years. Let's get the present value of these coupons based on the YTM. Divide the coupons by 1 plus YTM to the power of number of years from settlement. Let's total the coupon present values. Also, calculating the present value of the par value. It will be par value divided by 1 plus YTM to the power of years to maturity. Get the total of these two cash flows. Let's get the difference of the total with current price of the bond. This difference should be 0 at the YTM. We will use the goal seek for the YTM calculation. Our goal is to get the difference of price and cash flows as 0. By changing YTM. Now, we have got the YTM as 7.26%. So now we have learnt the crux of the YTM. Here is a quick and practical way of calculating the yield. For this, just type is equal to yield, enter all the data about the bond from the settlement date to frequency of coupons. The important thing to note is the frequency of coupons is annually. Now, we have got the same value of yield as our long method. Thanks for watching, please subscribe.